We are diving into a topic that usually causes eyes to glaze over, but I promise you this specific angle might just save your financial future. We are kicking off the Great Showdown, married filing jointly versus separately. For most of us, checking the married filing jointly box is the default setting. It's usually the simple path. Today, we challenge that norm. We'll highlight specific, high-stakes scenarios where married filing separately benefits might actually outweigh the standard tax breaks. We're going to look at how specific friction points, like high student debt or significant medical costs, can change the math entirely. Whether you are looking for legal protection or cash flow optimization, this is about making sure your tax return works for you, not against you. Let's get into the showdown.
I want to pause here for a brief architect's note about the tools we have built to help you with these specific challenges. Most financial advice is just a collection of tips and tricks. It's like trying to run high-end software on buggy operating system. My job here at Save Simple Sound is to help you upgrade that operating system so that you can close the gap between knowing what to do and actually doing it. If you ever felt like you know what you should do but you're not doing it, it's not a knowledge problem, it's a capability gap. I have released the first 9 chapters of my book, Save Simple Sound, as a foundational guide to help you debug the system. Details on your screen now.
For the vast majority of couples, probably 90 to 95% of you, married filing jointly, MFJ is the default setting. It usually gives you the widest tax brackets and the biggest standard deduction. It's comfortable, but comfortable isn't always safe. Sometimes you need to pull the emergency brake. That is where married filing separately MFS comes in. I want you to think of this not as a tax-saving strategy, but as a risk management tool. This is the safety play. Let's get technical for just a second with a phrase that should scare you a little bit. Joint and several liability tax. When you sign a joint tax return with your spouse, you aren't just saying, here is our money. You are signing a legal document that says, I am 100% responsible for everything on this paper. If your spouse makes a mistake, maybe they forgot to report income from a side hustle, or they inflated a deduction, or they owe massive penalties, the IRS doesn't care who earned the money. They can, and they will, come after you for the full amount. Even if you get divorced later, that joint return binds you together financially. So who is the audience for this safety play? If you are currently navigating a separation or a divorce, married filing separately benefits you by creating a firewall. It keeps your tax life in a distinct silo. But it's not just for those ending a marriage. I want you to ask yourself a tough question right now. How much trust do you place in your spouse's financial transparency? If you have a spouse who is a bit of a financial cowboy, maybe they run a business with messy books or they have a history of non-compliance, filing separately is your insurance policy. You are essentially telling the IRS, I am responsible for me and only me. Now there is one important nuance here. I hear this mix up all the time. Let's say you trust your spouse, but they have some baggage. Maybe they have old student loans in default, or they owe child support from a previous relationship. You might be worried that if you file jointly, the IRS will seize your refund to pay their debt. In that specific case, you might not need to file separately. You might just need the injured spouse allocation. This is where you file Form A379. It basically tells the IRS, hey, we are filing together, but please don't take my share of the refund to pay their old debt. It's a vital distinction when looking at injured spouse versus innocent spouse scenarios. So here is the reality check. Is the potential tax savings of filing jointly worth the risk of being legally liable for your partner's tax debts? For many of you, the answer is yes, of course. But for some of you listening right now, that question just made your stomach drop. Filing separately usually results in a higher tax bill, yes, but sometimes paying a little extra in April is worth the peace of mind that you aren't on the hook for a surprise audit 5 years from now. Here's what I want you to do this week. It's a simple homework assignment. Pull up your past 3 tax returns. Look at them. Did you sign jointly? Do you actually know what income was reported? Understand your current liability exposure before you sign the next one. Coming up next, we're going to move from safety to soundness. We're going to look at the math, specifically how filing separately might actually save you money if you have high medical bills. Stay with us. Now, I want to pivot to offense. We're moving into the sound strategy. This is where we stop looking at legal protection and start looking at pure hard math. Specifically, we are diving into one of the most overlooked areas of the married filing jointly versus separately debate: medical deductions. If you usually file jointly because you assume it's always better, I need you to lean in, especially if this year has been physically and financially demanding for your family. Here's the reality of the tax code. The IRS allows you to deduct out-of-pocket medical expenses, but there is a catch. It's called the Medical Expense Deduction 7.5% rule. Think of this like a high jump at a track meet. You don't get any credit for clearing the bar until it's set at a specific height. That height is 7% of your adjusted gross income, or AGI. If your medical bills are below that bar, you get nothing. You can only deduct the amount that goes over the bar. Now, here is where the strategy comes in, the math of separation. Let's use an example. Imagine a couple, Tom and Sarah. Together they earn $100,000. For them to deduct one single penny of medical expenses, they first have to spend $7,500 out of pocket. That's 7.5% of their combined income. That is a very high hurdle. But let's say Sarah had a tough year medically. She had surgery and extensive rehab costing her $8,000 out of pocket. If they file jointly, they can only deduct $500, the amount over that $7,500 hurdle. It's hardly worth the paperwork. However, what if they file separately? Let's say Sarah's individual income is only $40,000. Now her 7.5% hurdle drops all the way down to $3,000. Since she spent $8,000, she can now deduct $5,000 of her expenses. By separating the incomes, we lowered the denominator, lowered the bar, and suddenly, a massive deduction appeared out of thin air. This is why married filing separately benefits a very specific demographic. We see this often with older couples, where one spouse requires long-term care or assisted living, or younger families hitting a catastrophic health event. When one spouse is sick and the other is healthy, combining your incomes might actually be hurting your ability to get tax relief. I know the question popping into your head right now. Alex, can I deduct medical expenses if I file separately without getting hammered by higher tax rates? That is the million-dollar question, or at least the $1,000 question. This brings us to calculating the net benefit. See, filing separately usually comes with higher tax brackets that kick in faster. So you have to weigh the tax savings from that massive medical deduction against the potentially higher tax rate you'll pay on your income. It's a tug of war. Does the deduction save you more money than the higher tax bracket costs you? I want you to take a second and reflect on your last 12 months. Have you or your spouse experienced a significant health event this year with high out-of-pocket costs? If the answer is yes, you need to ask yourself, does separating your incomes allow the medical expenses to clear the 7.5% hurdle where a combined income would not? Don't just assume the default is the best path. I want you to go gather your medical receipts for the year, prescriptions, surgeries, therapy, dental, total them up. Then calculate 7.5% of your joint income and 7.5% of your individual income. See if that lower hurdle unlocks a deduction you didn't know you had. But medical bills aren't the only reason to separate your finances. For our younger listeners or anyone with professional degrees, the next segment is huge. We're going to talk about how filing separately can save you hundreds of dollars a month on your student loans. But now I want to pivot to a scenario that affects a huge chunk of our listeners, especially those of you in your late 20s and 30s. We are talking about the elephant in the room, student loans. If you are currently repaying federal student loans, specifically under an income-driven repayment or IDR plan, the showdown of married filing jointly versus separately isn't just about taxes. It's about survival. It's about monthly cash flow. Here is the sound logic. When you are on an IDR plan, your monthly payment is calculated based on your discretionary income, which starts with your adjusted gross income, or AGI. If you file married filing jointly, the loan servicer looks at your combined household income. They take your salary, add your spouse's salary, and calculate a payment based on that big, beautiful total. But if you file married filing separately, you are essentially putting blinders on the loan servicer. By isolating your tax return, the calculation usually ignores your spouse's income entirely. They only look at your income to determine your debt payment. Let's look at an example to see why this matters. I want you to picture the high-debt professional. Let's call her Sarah. Sarah is a resident physician. She has $250,000 in medical school debt, but because she's still in residency, she's making about $60,000 a year. Her husband, Mark, is a software engineer making $150,000. If they file jointly, the government sees a household making $210,000. Sarah's monthly student loan payment could skyrocket, potentially eating up a huge chunk of her actual take-home pay. However, if Sarah and Mark choose the IDR plan filing separately route, the loan servicer only looks at Sarah's $60,000. Her monthly obligation drops drastically, sometimes by hundreds or even over $1,000 a month. Now, this brings us to the sound trade-off analysis. And this is where you have to put your strategist hat on. By filing separately, Sarah and Mark might lose some tax credits. Their actual IRS tax bill in April might go up by, let's say, $1,500 because they lost the better tax brackets. But if filing separately lowers Sarah's student loan payments by $500 a month, that is $6,000 in cash flow saved over the year. You are paying $1,500 in extra tax to $6,000 in loan payments. That puts you $4,500 ahead. That is a winning trade. So I want you to reflect on your own situation. Is your primary financial pain point your annual tax bill, or is it that monthly student loan cash flow? Does filing separately lower student loan payments enough to justify a slightly messier tax return? For many of you, especially doctors, lawyers, or anyone with a high debt-to-income ratio, the answer is often a resounding yes. Do not guess at this math. Go online and find a student loan repayment simulator. Run the numbers twice. First, input your data as married filing jointly, and then run it again as married filing separately. Look at the difference in that monthly payment. If the gap is massive, you need to talk to your tax professional. But wait, before you rush off to file separately, you need to know what you're giving up. Because when you split that tax return, the IRS takes away some of the most popular toys in the toy box. Up next, in our final segment, we're going to cover the simple warning. We'll break down exactly which credits and deductions vanish when you choose to file separately, so you don't get blindsided in April. Stay tuned.
We have covered the theory. Now, a quick word on the resources available to help you with actual implementation. If you are realizing that your financial system has grown too complex to manage alone, instead of looking for additional products, look for diagnosis. Most people try to perform surgery on their finances even before they understand the pathology of their problems. I invite you to Clarity Diagnostic. This is a 30-minute pressure-free session where we look under the hood of your finances to look for any integration errors that are causing you anxiety. No sales pitch, just professional diagnosis of current state and a clear path forward. Book your session. Details on the screen now.
So let's transition into the final piece of our puzzle, the simple warning. We need to talk about the price tag of separation. When we look at married filing jointly versus separately, the IRS generally wants you in the joint camp. To encourage that, they've built the tax code to penalize separation in some pretty specific ways. If you decide to go the MFS route, you need to know exactly what you are giving up. First, let's talk about the cost of separation. When you file separately, you are essentially walking away from some of the most valuable tax credits available. Think of it like a loyalty program that you're opting out of. If you file separately, you are generally disqualified from the Earned Income Credit EIC. Gone. Education credits like the American Opportunity Credit or Lifetime Learning Credit, usually off limits. And here is a big one for the parents listening, the Child and Dependent Care Credit. If you pay for daycare so you can work, filing separately usually means you cannot claim that credit. If you are banking on those refunds to balance your budget, these are major disadvantages of married filing separately that you have to factor in. Next, we have to look at the hard limits for next year. In the MFJ versus MFS 2025 showdown, the deductions get tight. For the standard deduction 2025 married filers, the joint number is a healthy $31,500. If you file separately, that gets cut exactly in half to $15,750. That seems fair, half for you, half for your spouse, but the pain comes with the SALT cap. That's your state and local tax deduction. For 2025, joint filers are looking at a $40,000 limit, but for separate filers, it's slashed to $20,000. If you are living in a high-tax state, I'm looking at you, New York and California, and you own a home, hitting that $20,000 ceiling is dangerously easy, and you could lose out on valuable write-offs. But the one that catches most people off guard involves your nest egg. We have to talk about married filing separately IRA deduction limits. Here is the reality check. If you or your spouse are covered by a retirement plan at work, like a 401k, and you try to deduct contributions to a traditional IRA while filing separately, the IRS stops you almost immediately. The income phase-out starts at just $10,000. That is incredibly low. It essentially means if you have a job, you likely lose the deduction entirely. So this brings us to our final verdict, the S3 framework. How do you actually decide? Simple. This is your default. If you don't have massive medical bills, crushing student loan debt, or legal trust issues with your spouse, don't overcomplicate it. Joint filing is usually the winner for simplicity and lower total tax. This is the math play. You are specifically looking for married filing separately benefits, like the IDR student loan strategy, where the cash flow you save monthly outweighs the tax credits you lose annually. Safe. This is the liability play. You don't care about the credits, you care about protecting yourself from a spouse's bad financial behavior. I want you to take a second and reflect on your own situation. Are you reliant on credits like the child and dependent care credit that are strictly off limits to separate filers? Does your situation fit the simple default, or do you have the complexities to justify the sound or safe approaches? Knowing when to file separately isn't just about plugging numbers into a filing separately tax calculator online. Those tools often miss the nuance of state laws and specific credit disqualifications. So here is my challenge to you for this week. Don't guess. Schedule a consultation with a CPA to run a side-by-side comparison for the 2025 tax year. Tell them you want to see the joint return next to the separate return. Look at the bottom line, both the tax owed and the monthly cash flow impact. Make the decision with your eyes wide open. And that brings our strict look at the showdown to a close. We've successfully dissected the complex decision of married filing jointly versus separately, moving past the default settings to find the strategy that fits your specific life stage. Today, we saw that while the simple path of joint filing usually wins on paper, the sound and safe paths exist for a reason. We uncovered the math behind married filing separately benefits, specifically for those of you facing high-stakes situations. Whether you are a professional looking at IDR plan filing separately to manage monthly cash flow, or a family navigating a health crisis trying to leverage the medical expense deduction 7.5% rule, the key takeaway is that you have options. But as we discussed in our final segment, don't ignore the trade-offs. The MFJ versus MFS 2025 deduction limits and the loss of key credits like the EIC are real costs. Before you make the switch, I highly encourage you to sit down with a CPA or run the numbers through a filing separately tax calculator. You need to see if the monthly savings on debt or the liability protection are worth the potential higher tax bill. Thank you so much for tuning in. I hope this episode gave you the clarity to seize financial control this tax season. If you found value in today's breakdown, please check the show notes for a link to the comparison table we discussed and consider leaving a review. It helps us reach more listeners like you. Be sure to subscribe so you don't miss our next episode. Until then, keep asking the hard questions, check your math, and stay safe, simple, and sound. This is Alex, signing off.